Hi, my name is Roger Schlueter. This video is actually about the 15 reasons that banks say no to business loans. And I know we all like to think they say yes every time, but I tell you, they probably say no a lot more times than they actually say yes. So anyway, this is the 15 reasons banks say no to business loans. And this video will cover 15 reasons that the banks say no to business loans with an explanation for each reason. So anyway, please subscribe and hit the bell for upcoming videos, and share and like this video as you see fit. Thank you. The number one is really lack of cash flow from the company. And this can be a downward trend of the cash flow, or it can be that the cash flow does not cover the debt service of the company when this new loan is added. Banks like to see increasing value of cash flow, and they like to see debt service coverage ratio of at least 1.25 to 1.30 to 1. Now, this is the amount of cash that covers the debt service. So you basically have 1.25 times that the cash covers the debt service, for a company on a yearly basis. This is very important to the banks. This is a very big metric for them. Number two would be poor credit of the owners of the company. Most banks would want the credit scores of the owners or the individuals to be like 700 or above. Usually 650 to 700 is an acceptable range. There is such a thing as a business credit score, but most banks do not think the platform is really acceptable. They don't really like it. So most banks do not use this metric. Now, SBA in some of their programs will use this metric. I'm not sure why, because a lot of times SBA really follows the banks, but banks usually do not use the credit for the businesses. They just use the credit for the individuals. And like I said, if you have a 650 or above, you're okay. If you have over 700, you're fine. But some of those vary. I mean, I've used TransUnion is one who's used in my area the most. But you have Aspirin, and then you have, I forget the other one. But anyway, you have those three, and they can vary. You would think if they use kind of the same type of a metric that they would all be the same, but they're not. So anyway, it is good if you if you ever get turned down because of your credit score, you might want to go ahead and talk to the bank and say, hey, which one did you use, and maybe look at a different one also. And you could do that on your own, and you can pay for the score. You don't get that free. So anyway, number three would be poor historical results of the company. Banks will usually get 3 to 5 years of tax returns, and they usually get an interim financial statement for the partial year, because no matter where you're at, you're going to have a partial year. Banks put these numbers on a spreadsheet and will evaluate the progress of sales and earnings of the company over the years. And they look at a lot more stuff. I mean, because they have the tax returns, they look at accounts receivable, they look at accounts payable, they look at the expenses as they go and what percentages they are. I mean, they can overanalyze this, dramatically. You wouldn't believe it. But anyway, usually they just look at the sales. They like to see sales going up over the years, and they usually like the earnings to be going up. And they definitely want that cash flow to be able to cover that debt service, the new debt service and the old debt service, all the debt service together. Number four would basically be documentation that is lacking in the form of substance. Businesses should put together a short business loan proposal for the bank that will detail the information that the bank will use to evaluate the loan. Now, I have a video on this short business loan proposal. If you do look at it, look at the one that is the new one, NEW, because the first one was the very first video I ever did, and it's not as good. So anyway, if you use the short business loan proposal video, look at the one that says short business loan proposal new. And anyway, on the actual thumbprint, it might say new and improved. I'm not really sure, but anyway, so do look at that though, because that is very good. And there's a lot of good information there that really gets you, will tell you exactly what the bank is looking for. And then, of course, I have some other videos that go over each of those subjects. So you'll like it. Number 5 is insufficient collateral to support the business loan. Most banks want collateral which is 100% or more of the loan's value. And the more collateral the business can give, the better the collateral. Banks will also want collateral that can be turned into cash if the business defaults, and they would like it to be turned into cash rather quickly. So the better that collateral is to turn into cash, probably the best. They really like homes, people's homes. They really want to take those because they can tell what it's worth, they can tell what it'll sell for, and they know how quickly they can get their money from the market. So homes are something banks understand. So don't be surprised if they say, hey, I want your residence, So anyway, as collateral. Number 6, income of the business. Most banks will want the company to show adequate income to pay back the loan. The bank will also do a debt-to-income ratio that shows the percentage of debt the company has in relation to the income of the company. The lower that ratio, the better. And a lot of times they'll do what is called a global debt-to-income. Well, they'll actually take the business debt-to-income and then they take the individual debt to income, and they put them both together to do a global one. Banks do that more and more really now. So anyway, number 7 would be a business plan. The bank will want to see that the company has done some planning on what they want to do with the loan proceeds. And if the company can afford this loan, business plans can be lengthy, but what you want to cover is really the short business loan proposal, the new one, that I have, and I would really go over that because I remember being a banker, and I swear I would look, somebody give me a business plan that was like 100 pages long, and I would turn to about 3 or 4 different parts of that. I would turn to the financials, I would turn to the projections, and then I would turn to the personal financial statement, and then I would probably look at the front to see what he wanted to borrow the money for, and maybe look at see if he had any experience in the business. So really, no matter what you give, you can overdo it with information. The bank will still look at those. So probably about 8 different items that he will look at, and the rest of it he's not going to read. Now, I would say what is different is if you're talking a startup or you're talking high-tech stuff. Usually bankers will read the whole thing, the whole report, because one, in high-tech stuff, they don't know that well. And number 2, in a startup, they want to make sure you did your homework and everything. Anyway, so number 10 is basically time in business. The bank would like to see at least 2 years in business or longer. 2 years is the SBA definition of an existing business. They have to be in business for 2 years. And less than 2 years to SBA would be a new business. Even though you've been in business like a year and 3/4, it doesn't really matter. But anyway, to a bank and SBA, the longer the time in business, the better. So if you're a brand new business or if you haven't been in business long, try to bolster that a little bit. Try to find some good things about it that you've been doing that really make that negligible. So anyway, number 11 would be the management team. And the bank would like to see a management team that is competent and educated either in the business aspects or, by education or by experience. I mean, they're fine with experience. I've gotten loans from people that never had a day in college or anything else, and they've been in business for 20 years, and they know it inside and out. So that is really, and by management team, I think, if we're talking a couple people that own a business, if we're talking one person that owns a business, try to bring in your accountant, try to bring in your legal, try to bring in these people and say, hey, I've got these people to help me in case anything goes wrong or in case I need them. And accountants definitely, name the accountant, name the accounting firm that you use, and lawyers are the same way. You want to make them know that these people are part of your business and they're going to help you succeed. And number 12, the bank would really like the business to be in an industry that's growing and is not hampered by external forces. You really want to be in a growing industry. And the problem is that coming up, sometimes you have to, recessions and things. And a lot of times, an industry that's growing, for 1 minute, then all of a sudden, you hit a recession and all of a sudden it's not. There are some businesses that do well in recessions or better than others. And there's also some that do not do very well at all. And I'll have a couple of videos coming up on those two aspects exactly. Number 13 would be economic concerns. Sometimes the economy is weak and most businesses will be under pressure to produce a profit or show any growth. So, and that's not really the industry stuff. That's more like well, it would be more like a recession or the economy itself. I mean, sometimes it can just be so burdensome that no businesses do well. And banks usually recognize this. So, really just because you're not doing that well because nobody's doing well is still a good time to probably talk to your banker and maybe, get a loan for reducing some costs or doing something that's going to help your business. 14 would be personal guarantees that are needed by any of the owners of the business. Most banks, I mean all banks, they're not willing to give into this area. All owners will sign a personal guarantee, and that's pretty normal. I mean, I had a business once that did business with me for a while, and he said, "What's it going to take for me not to do a business plan?" And I said, "I don't know. A huge net worth. Being able to, where you really don't need the money." And if it's over, really, they're always going to take a personal guarantee. You might get them. I mean, the really larger companies usually don't. But I mean, I think most of the people looking at this video are not your Anheuser-Busch's, or InBev. I think they're just, companies that are just trying to, trying to get along and trying to make it. And they could be some really good businesses. But usually the bank will take a personal guarantee. I would say 99% of the time they'll take a personal guarantee. So anyway, number 15 and the last one, the banks do not like the company to have all its sales with a few customers, and they call this a concentration. They do not like concentrations of sales to just a few customers. They don't like concentrations of accounts receivable to just a couple companies. The concentration metric is very subjective, and banks can have very different views in the subject. But I tell you, if you're a company and you do business with one other company, that better be pretty strong, a strong bond, and really not be able to break, because they're going to look at that very negatively. In case you lose that customer, you got nothing. If you have 5, 10 customers, then if you lose one, it's not that big a deal. You can always make do, and then you can always get a customer back. So anyway, let's see. The banks usually will approve the loan or decline the loan. Usually they don't do much else. You might some community banks that will go ahead and try to tell you, why you were rejected and give you advice on how to rectify the situation. But these are mainly smaller community loans or community banks. And then, if you do get turned down, there are alternative forms of financing for your business. I have a video on alternative forms of financing. Some of them are like equipment financing, friends and family, everybody loves that one, accounts receivable financing, and merchant cash advance. These are some of the other ones, and you can, if you watch that video, you'll learn all about all of them. Anyway, companies need to go to the bank prepared, and I advise a business to prepare a business plan or short business loan proposal to give to the bank the information they need to approve the loan. And I guarantee if you give them all the information in the short business loan proposal, the new one, I guarantee you'll either get the loan or you'll get the bank to say, hey, come back when you fix this or this or this, because you will be prepared. So anyway, please subscribe to the channel and hit the bell to be notified of future videos. Also, please hit the like button and go ahead and share this video. I mean, feel free. So anyway, thank you very much. My name is Roger Schlueter, and I will see you in the next video. Thanks.